Good morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market short. Before we get started, please take a look at the shared disclaimer. Be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This show is for informational purposes only concerning Market Chameleon tools and products. One last look at the disclaimer, a little house cleaning note with the holidays. We won't be having a show tomorrow, which is Christmas Day, or Thursday, but we will be back on Friday for a morning webinar. With that, D, good morning, buddy.
Good morning, Will. How are you?
Excellent.
Good morning, everyone. Let's get started here. I'm going to share my screen. And today we'll cover a screener that it detects the different complex orders or multi-leg trades for there's a lot of trades going on in the market that are single leg trades, buy and call or put, but we also have a lot of multi-leg trades like spreads and butterflies and so forth. And this particular screener focuses on those multi-leg trades, scans and keeps them organized, makes interpretations for us on what these multi-leg trades look like, stitches it together and gives us an interpretation of the particular strategy, and then it puts it into a screener. So we're going to take a look at that right now. Let me see why I have this up here. 1 second. So to find that screener, if you go on the top menu, click on screeners and go to this multi-leg trade screener down here, click on that, and you will open up this particular page. And what you will see here is filters above, and then below we get this table, and you can see there are over 4,800 items here. You could tab through it, filter, sort. These shows you the top 5 right now. It is sorted by the highest contract volume. So whatever spreads it's looking at, it's sorted by the highest contract volume traded. So these are actual options trades. Okay, we're not screening the bids and offers, but we're looking at something that was reported as it traded in the market. And then this screener helps us to quickly view what's going on in those multi-leg trades. And a lot of people use the trades, the options trades, for various purposes. One is to understand what's going on in the marketplace, what are people trading, what are the values they're trading at, the volumes, the particular instruments, is it ETF, whether it be ETFs or single stock equities, maybe industries. And then some people, besides gaining insights into the markets, use these screeners to get trade ideas themselves, because you could see and observe different spreads that are trading in the market, and now there's interest in it, there's volume in it, there's an established fair value or easier way to get price discovery and analyze it further. So many traders look to these spreads that are traded to find opportunities. Okay, so let's review a couple of these items. Right now, you could see while we're on the multi-leg trades over here, we have these top 5 spreads, okay, that traded by volume, and we could see, 1, 2, the first 2 are in SPY. Then we have one in NVIDIA, we have one in IWM, and then we have one in Tesla. Okay, these are the top 5. If you tab, you'll keep finding more, you can, if you want to put in a symbol, let's say you're interested in only Tesla for now. If we put in TSLA, now we have 265 spreads in Tesla. Again, these will be sorted by top by contract volume. Okay, so as I have Tesla, you could see here Tesla, the between 254.17 and 257.02. So there are various, this particular spread traded multiple times because we have a time range, traded over 105,000 contracts, 105,052 contracts, 80 total trades. And here's the interpretation of it. It was a double diagonal call spread. These are the legs, December 27, 505, 504 call spread, and the January 3rd, 455, 482.5 call spread. Okay, if you open it up, then you get more details about the spread. However, let me go back to our original page where it shows the top 5 unfiltered. So SPY here, we see between 1054.52 and 320.49. So the first trade in this put butterfly was at 1054.52 a.m. The last trade we had was at 320.49. Keep in mind, this is the previous day's close. We're not open yet today, so we're looking at previous day's close. It traded 300,084 contracts, traded 3 separate times. We interpreted this as a put butterfly. It was on the January 24th, 2025 expiration, and it was the 400, 450, 500 put butterfly spread. So you could see here, put butterfly, 3 legs. So the ratio would be 1/2/1, right? That's how the put butterfly looks like. There are 32 days left to expiration. So for convenience, we don't have to do that in our head. January 24th, 2025, we got 32 days left. The strikes are $50 apart. This looks like it was a new position, and it traded for a price of 18 cents on average versus the market 16 cents, 20 cents. So right in the midpoint with the stock reference $588.92. We could also see there was another put butterfly in SPY 1057.18. One time it traded 300,000 contracts. This one was in January 31st expiration. So same strikes, but different expiration. So you could see the difference here. One's 32 days, one's 39 days apart. And when we see this little arrow, okay, this little arrow allows us to click on it, and it will take us to the options chain in SPY, populate the legs of that spread. It will default to, which buying and selling, but you could switch it, analyze it from both sides, because, there are 2 sides to the spread, right? There's a buyer and a seller, so you could analyze it from both sides, but to make it easier, just default to one side and allows you to switch. And we could analyze it further. We could also look at it in here. We could open this up just to get some more information. And you could see here, it traded 3 times. So these would be the time in sales, traded at 320.49, a volume of 80, at 131.19, a volume of 4, and then at 1054.52, 300,000. Okay, so these maybe are piggybacks because they look pretty small. But if we look at the original one, you click on this details, and then you get all three legs. So you can see here they were executed at the same time. The 500 put on January 24th, 25, the 400 put, and then the 450 put. So you can see the 450 put traded 150,000, while the wings, the 475,000, and this was 75,000 contracts for a total of 300,000 contracts in that spread. These are the prices that each leg traded. This is the notional value. So you can see we're talking about a trade that involved millions of dollars worth of options. In dollar terms, these were the bid and offer of each of the legs at the time. These are the implied volatilities they traded at. You can see it's not a lot of deltas to it, not a lot of open interest. That's why we tagged it as a new position, because the open interest on each of those legs prior to this trade were in the hundreds, not in the thousands. All of them traded on the SIBO. You can see here multi-leg trade. So this goes down all the way to the details. I'm going to close this for now, and let's close this. Oh, here, this tells you it last traded at 14 cents, but VWAP price all of them 18 cents, and that's because you could see 300,000 traded at 18, and 4 traded at 14 cents, 80 traded at 14 cents. But I'm going to close this right now, and let's say we do get this little arrow here that says this one we could populate in an options chain and analyze it further. And let's say we wanted to see more, we're curious what they might be thinking, get some insights. Are we interested in it? So let's click on this little arrow that I'm hovering over. And when you click on it, you go to the SPY. So now I'm on the SPY, right? Because that's what the spread was in. We're on the SPY options chain over here. It went to that January 24th expiration. Okay, where the spread traded, and for convenience, it populated all three legs. So you could see here, buying the January 400 put, selling the January 450 put 2 times, right? This is the ratio. Buying the January 500 put 1 time. So if you wanted to reverse this, you could just click reverse, and then it'll do sell, buy, sell, reverse, buy, sell, buy. You could analyze it from either side. Okay. Let's keep it at this, and let's run the analysis and say, like, okay, what was if this is the spread, and analyzing the spread from this particular side, we might want to know, well, what do we think the value of the spread is versus the price it traded, the market price, and a theoretical value based on our historical data and model. Where is the sweet spot of the spread? Like, what is the aim? What is the goal of this particular spread? What is he targeting? How did the spread change throughout the day? We could have all these questions about this particular strategy. So we could run the analysis and start getting some of these questions answered. So I'm going to run the analysis here. And now it loaded up a lot of data for us to take a look at in analytics. So here we could see that this spread, if we, line it up, with these prices, is 13 cents right now. 9 cents, 13 cents is the spread value. Based on how the stock moved historically, right, given the amount of days left to expiration and how the stock behaved historically, In theory, this spread we look at is essentially worthless based on history. Doesn't mean it something can happen, but in our history, it hasn't moved enough to make this spread, you know, worth that much, or so far zero. What about based on how the options are priced? So that's based on how the stock behaves. What about how usually the options are priced? Okay, because the options can always give some probability or some odds of something happening, even if it's rare or never happened, but maybe there is a chance, that something can happen. How does the market price that? So based on historical implied volatilities with similar options, in theory, the average value of the spread would be 10 cents. So close to where it was. I think it traded at, let me go back to it. So here, the VWAP price is 18 cents. Okay. So it closed, you could see, lower, between 9 cents and 13 cents. In theory, if we use the average prices based on the implied volatilities, if we looked at our history, it would be priced around 10 cents on average, with the median price of 8 cents. So the median is if we split our observations in half, if we sorted highest to lowest and looked in the middle, it would be 8 cents. Half of the observations were above, half below. And if we wanted to look at the lowest and highest range historically, it would be between 2 cents and 61 cents. Okay. So you can see a wide range. Maybe, when implied volatility is higher, this is worth more. When implied volatility is worth less. But right now, you can see we're above the average and median price, but on the low end of the high-low range. I'm going to move down just to save some time. This is the current market. So we see that the bid and offer is 9 cents, 13 cents. It's 4 cents wide. And it doesn't seem that wide. 4 cents is relatively narrow, but we are dealing with low price. 9 cents, 13 cents it's a very low priced spread here. So 4 cents might be more meaningful when you have lower prices. Right? Like 4 cents, if you have something $50, is not as significant as 4 cents, and you have something that's 10 cents, worth 10 cents. So keep that in mind with midpoint of the level. And we could see that it did trade mid-market, right? So there's room for negotiation, and you have to keep that in mind, that execution is a big part of trading, execution quality. It adds up, makes a very big difference in the long term. So you're always trying to see if you could get a better quality execution. This is the risk sensitivity of this spread, but you can see there's not much delta or gamma Greeks because it's way out of the money. So I'm going to go to this chart here, and this chart is kind of giving us the sweet spot here. If we lined up this spread with the legs this way, right? Buying the 5 with the 400 put, selling the 450 put, buying the 500 put. Well, the stock right now is over here, right? Near 600, let's say 594. This is where the stock is now. So where do we want it to go if we had this spread, right? At expiration, ideally, where do we want it to go? So you could see that this would be a bearish outlook because you want it to go down, right? That's where you start profiting. You want it to go down to those strikes that you did the spread at, way out of the money. And your sweet spot, ideal spot, is right that middle strike right there, right? That would be at the 450. Why? Well, let's take a look at it. We are long the 500 put, right? Jan 2500 put. So obviously, if you're long the 500 put, you want the stock to go down. But below that 500 strike, you're short 202 of the 450 puts. So you don't want the stock to go below your short strike, but ideally, if it closes right at that strike, well, then these will be worthless and you collect all that premium. If it goes below, well, you sold two, bought one. So you're going to lose, right? That's not exactly one put spread. 1-for-1, you sold two of these. So you're stopped out at 400. Okay. So it's like buying a put spread and selling a put spread. That's the butterfly. And then this makes sense that 450 would be the sweet spot, right? Right where we're short both. If those expire worthless, we keep that credit and we make on the 450 put. So this has a bearish outlook. And you could see that it's probably, guessing the exact right spot it's going to close at, it's almost impossible, right? It doesn't have to necessarily close right there, but if it does, then that payoff would be tremendous, right? It's a very low priced strategy, but what would it be worth there? Well, if the stock closed at 450, right? If it did close at exactly 450, you could see that your profit there would be 4,900, whatever it is. It will be, let me see if I have the max gain in percentage terms. What is that? 3,836 or 38,000%, something like that. Why? Because something that you paid 13 cents could be worth almost it'll be worth $50, right? You paid 13 cents for it, 18 cents, it'd be worth $50 because the difference between the 500 put and 450 put is $50. So that would be a tremendous payoff if you got that right. But it's very low probability, as we could see historically. We haven't seen this, happen. And another thing, it doesn't have to hit 450 and stop there. If the stock's price really starts drifting lower, this could be worth more, because as we go lower and lower, closer to the 450, the deltas will start changing, and that 450 or the 500 put, may be worth more and more. So this has like basically a bearish outlook from here. And that's the butterfly here. It has a pretty, you want it, if you have those legs, you want it to go down, right, closer to that 450 strike. How did this spread look like throughout the day? Does it sit there at 18 cents? Or does it move around? Because maybe he's not looking, or you're not looking to make that whole for 38,000%. But if it goes down and the spread moves around, from 13 cents to 20 cents or 13 cents, that's still significant percentage difference, right? You're still talking about, if it goes from 13 cents to, let's say, 26 cents, well, that's 100% return. So does that spread fluctuate? And let's take a look at it, how it performed on the previous day. So that's what this is, the price chart of this spread. And it looks at it from three perspectives. One is the midpoint. So the spread doesn't have to trade for its value to change, because these are derivatives. So the value of the spread will change as the stock's moving around, implied volatility is moving around, there's time decay. And to track that value of the spread, we reference the bids and offers. Right. So the bids and offers of the options will move around when the stock's moving around, implied volatilities are moving out, there's decay. So those option prices, the bids and offers are changing. So we could track the value of that spread. So this yellow line, solid yellow line, looks at the midpoint price because we have a bid and offer. So the value of that spread is worth anything in between the bid and the offer, where somebody's willing to pay for it, somebody's willing to sell it. So those are firm. So anywhere in between that. So in this case, we're going to look at the midpoint. That's the solid line. The dotted, like red line, burgundy, that's the bid price of the spread. The green dotted line, that's the ask price. So we got three prices there to track: the bid, the ask, and the midpoint. And they'll show us how the spread moved and how wide and narrow did the bid and offer throughout the day range. You know, did it stay consistent, like 4 cents, you know, a spread between the bid and offer? Did it get wider? Did it get narrower? What are the dynamics of these options? Okay, that's what this graph is allowing us to quickly view. And we could see if we track the midpoint price, the spread, the midpoint was as high as 22 cents. The midpoint was as low as 10 cents. The median price and average price was 14 cents. So even looking from the high low, 10 cents to 22 cents, it moved around, right? The value of that spread, you know, we're talking about small dollar value, percentage wise, it's a big difference between 10 cents and 22 cents. And you could see that the first, it opened up at 18 cents, the midpoint up here. And then by the end of the day, it went down to 11 cents, down 6 cents. And most likely, we see that this is a bear spread. It probably had, you know, implied volatility was higher when the stock was down. So we could see that here's the range of the stock, 587 to 595.30. And the stock was up 0.6, closer to the high of the day. So that's probably why it lost value, right? It moved away from those strikes, moved higher, right? You needed to go lower, moved higher. This has a short delta, you can see here. And probably the implied volatilities came in as, because you're long Vega, you can see here your long Vega, implied volatilities came in as the stock goes up. So it lost value, right? It went from in the morning from 18 cents all the way down to 11 cents by the end of the day. And now we got a good picture of, you know, what traded, what was the potential outlook given this trade, how did the trade look like throughout the day, you know, what was the range, what was the bid and offer range, what do we think it was worth based on historical stock behavior, what do we think it was worth based on historical implied volatility levels in similar options. So we were able to quickly kind of analyze and see, you know, okay, now I have an idea of what people are doing out there, how they're trading. You know, do I see this as a potential opportunity or a trade idea? And it's a way to learn about the option dynamics and option markets and, you know, potential open positions out there, and also find potential opportunities that, you know, fit into your overall outlook and positions and risk management. So, well, I'm going to stop right there. And I think we're off tomorrow.
Off
and
tomorrow and
Thursday, Friday.
Thursday, and we'll be back on Friday, and then we'll look at next week when it comes. But it's right around New Year's, so there may be a couple days we missed there. With that, we did have one question. I didn't want to interrupt the presentation. How exactly do you get to this page if you're on the landing page?
To to the options chain, the way I got it. Remember, we started from the multi-leg options trade screener. So under screeners, we go to the multi-leg trade screener. We ended up on this page. While we were analyzing this, for convenience, we have this little arrow. If you click on it, it will take you to the options chain and populate those legs for you.
Perfect. Perfect. People are always coming in, so someone did ask that. Great job, everyone. Thanks for the questions. Remember to like and subscribe to the channel. With that, Dee, you have a great holiday, and we'll see you on Friday.
Yep.
Bye, everyone.
Thanks, everyone. Stay safe out there. Have a great trading day. And yep.